Good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays. We can see somebody attended to Gypsy King's concert over the weekend. Olga, thank you very much for that lovely background music. Traffic is disrupted with the G15.5 underway at Nasrec, but year-to-date market seems to be steaming ahead, especially SA fixed income and equities. South Africa is in good standing with removal from the grey list and a recent credit rating upgrade by the S&P. And tomorrow we will see if the South African Reserve Bank will sit on their hands or not. But even if they do cut, how much of that cuts or expected rate cuts are in the current price? Should spoiled investors take some profits now with continued concerns of the US yields still creeping upwards? Who knows? It's my pleasure to welcome our presenters this morning, Bruce Sisselwhite from Oakhaven Capital, to give us an update on their business and to share some of their current views and why boutique managers are well suited for the current environment. Bruce will be followed by Kupano Muka from Mazi Capital, looking at the multi-asset portfolios and their positioning from an asset allocation point of view. Good morning, gentlemen. Thank you so much for joining us this morning. It's really great to have you on board, and thank you for your time. To our audience, you know how it works by now. Q&A bubble at the bottom. If you have any questions from the presenters, please pop it up, and we'll address questions after both presentations. Bruce, you up first. If you can start sharing.
Thanks again for the opportunity to present again to yourselves and to everybody who has come in to listen to us. Oakhaven, as we mentioned, it's a boutique asset management company. We mainly fixed income. Of late, though, we have gone into the property sector as well. We've employed Zwelelaki Ngomazulu, who is part of our team now. He comes with a lot of property experience. He also cuts his teeth in hedge funds. And a lot of what I'm going to talk about really today is who are your PMs managing your money. And the focus at the back of that is the PMs who seem to run hedge funds seem to be a lot better at managing long-only funds as well. And again, just a little punt for BCI. Obviously, from the boutique side of things, that's exactly the area that they are supporting. So we've got a bond fund and income fund. We've just started a flexible property fund. And then we've got two hedge funds, our strategic income fund and our property market neutral fund. And as I mentioned, from our perspective, you'll find that actually most of our, most of our resources and that is actually spent on the hedge fund side of things, and that's where we cut our teeth, and that's where we understand all the products that we deal with. Today, I'm actually talking about the core income fund, obviously, and the performance. You'll see that we're very happy with the performance that we've had. We've had numerous awards for this income fund. Those were on the previous slides. And we feel that we're positioned very well going forward for the next 2 to 3 years in the products that we actually have in this income fund at the moment. So just why do we think our funds are different to other funds? What you'll see is the PMs on the hedge funds are actually the PMs on the long-only funds, whereas these big mainstream asset managers, what you'll find is the PMs are generally they only look at fixed income, they only look at the money market fund, or they only look at the income fund, or they only look at a bond fund and things like that. So where we try and differentiate ourselves quite a bit is because we trade across the curve. We trade 0 to 30 years. We trade inflation linkers. We trade all the stacks in the bank. So we'll trade AT1s, Tier 2s, senior debt, NCDs. So from that perspective, we trade everything that you can actually see around the fixed income market. So what generally happens in these big houses is at the end of the day, you can come in and you can earn cash plus 100 quite easily. What you see here is you see here your 5-year government swap or floating rate notes. You see your AAA corporates, and then you see your bank senior debt. And you can see that at the moment, what most of the funds will give you in the income side of things is they're going to give you cash plus 100. That's really and when I say cash, it's linked to JIBAR, but JIBAR is very close to cash. So I'll just always talk about cash plus 100, and that's what you're going to get from those managers. Whereas we try and use the full toolbox out there. There's a reverb here. So on the next slide here, you'll just see. So this is where I'm comparing the boutiques and the mainstreams. So what you'll see here is I've highlighted. This is the top 8 performers, and what you can see here is there's Truffle, Oakhaven, Terebinth, Sasfin, Taquanta, Matrix, Ashburton, ABAX. Now, of the top 8 over here, ABAX, Matrix, Terebinth, and Oakhaven they actually cut their teeth on hedge funds, and you can see that their performance has been in the top quartile all the time. There are 2 other bigger names that you'll realize here, Sasfin and Taquanta, who were really good 5 years ago, but have dropped off the leaderboards quite dramatically over the last couple of years. And of course, what happens is because our fund size is manageable, it's very easy for us to change the ship and to move the ship around. So what you'll see here is the big names, Ned Group, which is actually managed by Taquanta mainly, Stanlib, 91. I mean, if you look at their performances, this is out of 37 funds. You'll see that their performance are 26th, 35th, 20th. So they've obviously got a lot of money under management. And what you're finding is that you basically 2.5% every year. You're 2.5% behind what the top quartile managers are actually producing versus what your mainstream guys are producing. So that's just the mainstream versus the boutiques. Then the other catchy heading was everything, everywhere, all at once. And this is just to highlight how much good news South Africa has had over the past short little break. We're off the FATF grey list. Our inflation target has now been ratified by National Treasury at 3% with a 1% tolerance band. Debt ceilings are to be tabled probably in 2026, we're hoping. The S&P has just upgraded us from double B, upgraded to double B from double B minus, and we've got a positive outlook, which was actually much better than what was expected. Moody's currently have us at double B, and they've got a meeting on the 5th of December. And then Fitch still has us at double B minus, and their meeting is in March 26, which will be just after our budget process. So we think Moody's will probably put us on a positive outlook as well. So we're going to have both the S&P and Moody's with double B positive outlook, which generally they move within 12 to 18 months after that. So by this time next year, we think we could probably be double B plus, which would actually only put us 1 notch away from investment grade. And when you get to investment grade, we start talking about WIGB inclusions. Obviously, South Africa's commodity terms of trade has been really good. The income's up by 20 from the medium-term budget. Our income's up by 20. The need for Eskom's 40 billion in the latter years looks less likely as they become more profitable. Expenses are running behind. I do understand that they've allocated some more income to the expenses, but there's a possible saving of 20 billion there. Jafekra, the buffer's at 54 billion. That means they're releasing another 31 billion. And then the big one for South Africa is this new floating rate notes that they started to issue about 12 to 18 months ago. So they're actually competing with banks here, because now what's happened is your income funds are actually now starting to buy a lot more government debt because they link to JIBAR, which is sort of a cash rate. So that issuance is 70 billion ahead of budget. So all in all, really a lot of money in the market and a lot of money looking for a home, specifically in the income space and the fixed income space. On the 21st of December, there's going to be 90 billion that hits asset managers' accounts, bank accounts, and when the first leg of the R186 matures. And then the other really good news that came out was they cut every week. What happens is National Treasury issues bonds into the market, and that used to be 3.75 billion. It's now they've cut it by 750 million. It's only going to be 3 billion. So if you just do a simple mass calculation, there's 40. They auction for 48 weeks because they don't auction over December. Times 3 billion is 144 billion. Then they issue what they call a non-compete, so that if you won 3 days later, you can actually go and get 50% of what you tendered for, which will equal 216 billion. And then they issue slightly at a discount because yields are a little bit lower than where the yield to maturities are at the moment. So effectively, there's 184 billion of supply out there. Now, when you compare that, they're only going to put 184 billion supply out there, but the coupons that you get every year at the moment, and this is obviously because our debt to GDP is so high and we've issued so much debt, is 294 billion. So there's an oversupply of 110 billion looking for a home. So we're very positive on fixed income at the moment because there's all this coupon that's coming in. We also, if you look at where the JSE's gone, you know, the top 40 is up by 40% odd. The mining index is up by 190. The industrial's up by 25%. Financial 16 and property 21%. So if you look here at the bottom, if you look at the multi-asset thing, and maybe Kampana is going to talk a little bit about how they do their allocations. But if you look at the multi-asset, you know, we believe that in the multi-asset sphere, there's probably going to be a little bit of allocation change away from equities that run so hard. So not only do we have this extra 110 billion, we've also got some allocation stuff, and then we've also got some economic growth that could come through as well. So where does all this money find a home? So this is the South African universe over here, of which you can see that government bonds are 4.6 trillion, which is by far the biggest share. The second share, splitting the top part of the curve out, you'll see that over here. Where's the rest of it? And you'll see it's mainly financials. Where people will invest. So the universe in South Africa is actually shrinking from that perspective. And so we think that when you look at economics 101, demand and supply dictates that we've got a lot of supply out there. We've got a lot of demand out there and not as much supply as what we used to have. So we still like fixed income. We think fixed income is a good place to hide. And just the product that we like the most is inflation linkers. And just to draw your attention here, in the inflation link curve, you will see that you know, when yields are coming down, you'll see that your mark to markets are going to be positive, and that obviously makes sense. So yields are coming down, that's a black line. Your mark to markets are positive, which gives you really good return years. When yields are going up, your mark to markets are negative. So you can see all the pink is negative, and you can see the dark greens are really, really low. So your returns are really, really low. So we've been in inflation linkers now for around about 12 months. You know, we were buying them up at 5% over here. If you look at what's projected for 2025, you'll see that inflation linkers are going to turn just less than 12%. For the year, which is a really good return, mainly because obviously of this mark-to-market gain. And this is the weighted average coupon rates. These coupon rates are actually now down at 4.5%, and that's why you've got this mark-to-market kicker. And in a nutshell, I think that's why we think we're really well placed for investors. We give them a lot of opportunity to extract much more value than the big behemoths out there. And that's my story. Just a couple of disclaimers. Thank you very much.
Thank you very much for that. I've got a couple of questions on your income fund and current positioning, but we'll come to that in a bit. If you can stop sharing, then we'll get Mazi's slides up as well.
Okay, perfect. Thank you. Thank you for the opportunity to present, and good morning to everyone on the line. So I'm Kopano Maku. I'm the co-portfolio manager of the multi-asset. That's a balanced and stable product which we run at Mazi. And I'll be taking you through our thinking just in terms of how we navigate the turbulent oceans that are the market. So you know, effectively, if we move to the next slide, you know, in a world where where, you know, the world is defined by constant shocks, you know, so our goal is not, you can't avoid volatility. It will always be there. Uncertainty will always be there, but, you know, we need to manage it more effectively. So, you know, we're living in an environment where everything changes pretty fast. I mean, I think Bruce had an apt title there, Everything, Everywhere, All at Once, you know, and that's the kind of environment we're living in. Investors move from risk on to risk off within days, sometimes hours. You just need to go back to March 31st Liberation Day and see how markets reacted then. Investor behavior is hyper reactive. Markets are responding to headlines. They respond to opinions, social media, narratives. So not long-term fundamentals. Economic cycles themselves are becoming shorter, which means that data shifts pretty quickly, and market reactions follow even quicker than that. We also find that there's a herding instinct, right? So when uncertainty rises, investors start believing that the crowd knows best. And then we find that more often than not, there is a herding instinct or herding mentality within the investment world. And then decision-making also becomes anchored on a single narrative. So, and when that narrative breaks, you see volatility spike. So moving on, you know, so the age of whiplash, you know, what is this whiplash effect I'm talking about? So it's amplified by new catalysts. So I'm not going to spend time on AI advancements and you know, what the Chinese are doing, what the Americans are doing. That's well known. Geopolitics is a big geopolitical event happening down the road over the weekend. So, you know, these are new catalysts that we're seeing amplify this whiplash effect, amplify how the market moves. And then, you know, inflation is moving up and down. What do we think inflation will do? And we're also seeing shocks happening more frequently, right? So, and the question I pose is it a black swan event, or are we in a world of constant gray swans, effectively? So not quite the black swan, but gray swans. So all of this increases the need for now, in our minds, it increases the need for diversification more than ever. Given that the world no longer runs on long cycles, it's effectively running on fairly fast pivots. So on the macro side, volatility is driven by sticky inflation, which I've mentioned. So sticky inflation pressures combined with, you know, perhaps what are rates going to do? Do we have, you know, further rate cut expectations? Markets are repricing interest rate expectations almost weekly. So this, you know, adds to the uncertainty that's already in the market, right? Political instability, global elections, geopolitical tensions fuel further unpredictability within the market. You also think about China's slowdown, rapid cycles in US tech. So this all adds effectively to the roller coaster of, you know, which adds to the whiplash effect. In terms of the market itself, you know, we're seeing large daily movement in equity markets in particular. Bond yields are constantly being repriced. 6 months ago, we were talking about fair value of 10%. Now we're looking on the 10-year. Now it's, you know, closer to 8.5, 9, depends who you ask. So this affects everything from valuations to funding costs. Currencies are also reacting pretty sharply to sentiment changes. You know, so one headline can create massive swings, and of course, there's energy and commodity prices remain volatile. You know, so these are due to supply shocks, due to geopolitical events, and due to global shifts in demand. Okay, so what are investor pain points? When we speak to investors, what are they concerned about? You know, so in our mind, investors that are relying on a single asset portfolio as opposed to multi-asset, which is what we look at, more often than not, you can get caught off guard, you can get sideswiped. If an asset class turns, you find there's no way to hide. Bonds, for instance, which traditionally offered you protection, may not provide that consistent downside cushioning in a volatile environment. Local equities, you know, while we like local equities, they look cheap. For the most part, they do face some structural and cyclical changes if you're looking at a single asset equity portfolio. Property cycles have completely diverged across regions. So some markets are recovering while others are still kind of lagging. And then global equities are increasingly concentrated in just a few big tech names, right? So there's no, you're not getting a lot of diversification, particularly when you look at the S&P in the US markets. This creates risk and market fragility if those tech giants were to stumble or hit a hurdle. And then cash, for the most part, while it looked attractive while rates were higher, that was temporary. So, sitting solely in cash is never a long-term solution. And so what we do, we spend a lot of time looking at correlations, because in our mind, one of the biggest challenges is that correlations across asset and between asset classes are no longer stable. So that's what this chart is kind of telling you. Bond equity relationships can flip in a matter of months. So it makes it very hard to rely on traditional diversification. So when you put your portfolio together, you think, well, if bonds do this, then equities will do the opposite. That effectively, you can't assume that those old relationships will hold. So, for instance, in a high inflation regime, correlations effectively behave like teenagers. They're unpredictable and they're emotional. When inflation falls, diversification then reappears. But even that is pretty hard to time. Okay. Yeah. So moving along. So this slide shows how no single asset class wins every year. So that's effectively what we're trying to tell you here. And then no single asset class will lose every year either, right? So we need to keep that at the front and center of our thinking. Each year looks completely different. If you look back in history, sometimes equities will lead, sometimes bonds, sometimes cash, sometimes you find gold will outperform. And then on the slide here, look at how the leaders rotate. So especially during shocks like Nenagate, you've had COVID, the tech surge, you've had commodity cycles. So, they effectively, at any one point in time, you'll have a different asset class outperforming another. So this randomness of performance across the asset class basically then tells us this is why a multi-asset approach should work, right? So it captures returns from different sources at different times. Yeah, and you don't need to guess who the winner is. So a well-built multi-asset portfolio taps into multiple sources of returns. So why multi-asset now? So as I mentioned, it gives you multiple return drivers. So you're not relying on one engine to carry the entire portfolio. When asset classes rather diverge, multi-asset creates opportunities to reposition tactically and take advantage of those differences. And it also allows for selection within asset classes. So not all equities or all bonds are going to behave the same. So within the bucket itself, this is where we spend a lot of time. We then, are able to put our hat on and put our best ideas when we're building portfolios up from a bottom-up perspective. But most importantly, multi-asset smooths returns. So when a single asset becomes too volatile, the others provide some sort of balance. So as I've said, markets, they shift regimes much faster than in the past. So multi-asset allows you to make tactical adjustments fairly quickly. It also gives investors global opportunities. So while you avoid concentrated risk in any one area, we also have the ability to look at opportunities, not just in the States, but globally. So we think that there are opportunities globally. So this gives you the ability to look at domestic equities, global equities, and then also the other asset classes. And then downside protection is a key benefit. So when markets do snap, that diversified portfolio cushions the blow to a large extent. Then we also have the ability to include independent, non-correlated assets, which gives your portfolio more resilience. Okay, so this is it. So we've got all the tools at Mazi. We've got all the tools available to build these multi-asset portfolios. We've got the specialist equities, both global and domestic and regional, I might add, across the continent. We've got bonds, we've got property, we've got cash capabilities. So we've got all the capabilities to blend these different sources of returns into one portfolio, which is what we do. So we've got a lot of smart guys managing all these different asset classes, and then ours is to blend those into one portfolio, right? So, equities will give you the growth, bonds will give you income and stability, property offers you those real returns, and then cash effectively, especially in an environment like this, gives you flexibility or some dry powder. But for us, the real magic isn't in how each one performs on its own. It's how they interact, right? So when one engine slows down, one can pick up the pace, and then the interaction between them creates that balance and consistency over time. Okay, so this is how we think about allocations. So this process is disciplined, it's repeatable. We start by estimating returns, so we understand what each asset class is likely to deliver based on valuation and fundamentals. We do a 12-month and a 3-year view on the different asset classes. We then apply tactical views to adjust for current market conditions. From there, we optimize the portfolio. So we determine the best mix of asset classes depending on which portfolio, whether it's stable or the balanced, will deliver the desired outcome that we require. Implementation is purely about translating those weights into actual holdings. And importantly, we continually monitor and rebalance because as markets shift, we need to have the ability to adapt the portfolio. Okay, so when it comes to the funds, here we could compare the two funds that we have. We launched these two funds on the BCI platform earlier this year. So we have the stable fund, which sits in the multi-asset medium equity category rather, with a cautious to moderate risk profile, minimum horizon of 4 years. And then the balanced fund is in the high equity category, moderate risk profile, I would say, and minimum horizon of 5 years. And then the pie charts there, which you can look at, kind of then just tells you how each fund allocates between offshore and domestic, and also across the different asset classes. So the stable fund with more bonds is probably a little bit more defensive. So more bonds, probably more cash, both local and offshore. And then we've also got the balanced fund, which takes significantly more equity exposure to give you that longer term growth. And hence you've got the 5-year horizon. Our current thinking. So in our current thinking, I mean, we still like domestic equities in the portfolio. So over domestic equities, we see value and supportive fundamentals. We still think there is some catch up within some of the sectors within equities. Constructive domestic bonds, we have been probably become more selective now, given how much they've run. Cautious on global equities, particularly the US, given the super concentration. There are opportunities in other regions, globally and regionally, I might add. And then global bonds start to look attractive again. So not just looking at US treasuries, we think that in emerging markets, think Brazil, the real yields on offer in Brazil, Colombia, Mexico, and so on. So we do give some consideration there, despite the fact that we are underweight. So, we do consistently look at the portfolio, look at where the market is, and we are able to tactically adjust pretty quickly. And then we maintain a neutral to underweight stance on domestic property, given how much is run, and then underweight on cash. Okay, so I've spent a little bit of time explaining there. I think these are pretty stable. On a purchasing power parity basis, it is cheap, so that will support local assets as well, over and above the fact that we think that we are in for an extended period of some dollar weakness. Foreign equity is expensive, I've mentioned. Remain cautious on global equity allocations. I've spoken a little bit about foreign fixed income. So yeah, this kind of then just gives you a view in terms of where we think the opportunities are, and where we think that perhaps the investment thesis on some of the asset classes in the short to medium term has probably played out, and that's how we think about it, just in terms of our allocations. Okay, and then risks. I mean, what kind of risks are we watching closely, right? So we watch US bond yields have come off quite significantly. US equity markets rally, but I mean, how will these two asset classes interact with global asset classes and SA if inflation doesn't fall off as anticipated, if it remains sticky above the 2% target, or if labor markets deteriorate? What do you think will happen there? So this is something that we're thinking about we're watching quite closely. Secondly, although the rand looks stable, big question is what happens to SA if US markets in particular, if there's a correction there. There's a lot of talk about a potential correction there. China remains a risk factor. So their slowdown continues to ripple across global trade and industrial commodity demand as well. And then political uncertainty always remains elevated. So, we include here the potential impact of policy shifts in the US. Trumponomics is changing all the time, trade tensions, election outcomes. And then lastly, in the sentiment in SA, right? So for a long time, we've had pretty negative sentiment around the local economy. But what will it take to shift that domestic confidence? Bruce spent a little bit of time around the things that are positive in SA. And this remains an important driver for local markets, just that shift in confidence domestically. So for both domestic investors and then offshore money coming in as well. So if South Africa remains pretty attractive, then if South Africa's become more positive, then inevitably I think some of the offshore investors probably would be as well, which would be positive for us. Yeah. So in closing, if there's one thing that the age of whiplash has shown us is that uncertainty is the new baseline. Uncertainty will always be there. Markets will continue to shock us both on the upside and on the downside. Inflation will continue to surprise us, often in both directions. Geopolitics will remain a swing factor that we cannot ignore. And cycles are shortening, right? So I mentioned that cycles are shortening, meaning trends don't last as long and reversals happen faster. And then all of this kind of reinforces why flexibility and diversification matters, more at this point in time. Okay, thank you. So multi-asset, offers a strong, reliable way to protect capital in periods of stress, smooth volatility by drawing from different engines, which I've mentioned, and I reiterate. They capture opportunities across different asset classes instead of relying on that single market to deliver your outcomes. And importantly, it also then allows us to adapt in regime shifts. So, as I mentioned, some of those macroeconomic or market conditions, if they change, we have the tools at our disposal to basically say, we prefer to be in this asset class or that over a set period. So yeah, on the last slide, basically, all I just want to close here is saying that we live in a fast-changing, fast-adapting world. We don't need perfect forecasts because perfect forecasts don't exist. What we need are portfolios built for any environment, to be prepared for any environment, portfolios that can withstand those shocks, that can pivot with the market, and participate in opportunity without being exposed to any single or concentrated to any particular risk. And that's, in my mind, that is the strength of a well-constructed multi-asset approach. So it prepares us not just for a single future to say this is how things are going to land, but for every possible future, every possible expectation. Okay, thank you for that.
Well, thank you very much. Insightful indeed. Yes, you did mention your balanced and stable funds are fairly new funds, but your global equity fund, I think we're all familiar with that fund. Your colleague Andreas has been presenting on that now for a couple of years at a couple of roadshows. So we've got a fair sense of what Mazi does and what your approach is. But maybe if we can start with that, with your global equity carve-out, that one slide you showed with your neutral, underweight, overweight positions. You underweight global equity in your multi-asset funds. We understand your global equity funds is a global equity fund. But let's just talk a little bit about that allocation on global equity. Where do you find yourself at the moment? Are you starting to underweight the US in general, or are you starting to move away from the tech-heavy, overpriced mega cap stocks and still finding value in the US? Or do you start to fish in other ponds like emerging markets and the UK? What does that component look like?
Yeah, I mean, if you talk to our colleagues, they I mean, while you could argue that the portfolio is got a large concentration to US. I would argue that they don't have massive concentration to some of those the Mag 7 and so on. Their approach is slightly different. They look from a bottom-up perspective. They've got some pretty solid businesses in there which have pretty strong moats. But over and above that, what we have done and what we have the ability and capability to do within the multi-asset is we engage with them pretty often, and there has been a shift to some emerging markets. So we've got exposure in Korean won, we've got some exposure to companies like Novo Nordisk, we've got company exposure to Nubank, which is in Brazil. So there is some emerging market, and if you look at some of those markets, trading really cheaply, and there are definitely opportunities there. So while there is they do maintain that US tilt, I would say you're not concentrated in those Mag 7 stocks. I think perhaps there'll be an exposure to Microsoft, for instance, but not massive exposure there. But there's exposure to some pretty strong businesses out in the US, and then we also have the capacity to and what we have started doing is looking at other emerging market stocks there.
Over the past 6 months and looking forward, did you start to reduce your global equity exposure? I would assume so, because you're underweight. But then the flip side is in favor of what?
Yeah, so we have moved marginally underweight. And as I mentioned, it's not, we are able to move quite quickly here. So, if the narrative changes, or if our view on markets, or rather not the narrative, if our view on markets changes, we're able to move and shift quite quickly, right? So we are measured differently. We do have different outcomes, and we do have different sources of return. So we have gone overweight marginally domestic equities, and we like what domestic equities have done. If you think about what we measured in rands, you think of what the dollar's done. So in rand terms, SA markets have outperformed, and we're happy to have that. We review this we review it formally every quarter, but between Sean and I and the rest of the team, we do this every day. So we're able to shift and adapt pretty much at a whim when it's required. But moving more into equities, we've remained constructive domestic bonds, probably starting to shift that, and then looking at other opportunities as well. As I mentioned, potentially there could be other opportunities in global emerging market bonds, for instance.
Let's just look at the fixed income component, because especially in your stable fund, that's a big component of the overall portfolio, being capped out at 40% max equity. For the fixed income side, I mean, Bruce mentioned, and he spoke to things like ILBs, also mentioned the floating rate notes being issued by the SARB. But in stable funds and balanced funds having longer investment horizons, what does that fixed income component look like? Are you leaning still more towards fixed rate notes? So is your duration then, I would think, maybe perhaps a bit higher?
Yeah, I would argue it is a bit higher. What we have started to do though is to tilt a little bit more shorter. So we're happy with the returns that we've earned from fixed income year to date. Even last year. So fixed income has done pretty well. We spend a lot of time thinking about it. A lot of the positive news is in. We're starting to see the marginal buyers being foreigners, and you're still getting a decent real yield out of fixed income, right? So even at if your yields go to 8.5% with a low inflation target, to the extent that we're able to achieve it, you're still getting a decent real yield. So going a little bit further out the curve is not something that we're averse to. We do it. So while we've shifted a bit from some of the longer duration stuff, we've gone a little bit shorter, but I wouldn't say that we are short duration at this point, not at all.
Talk of the town on SA equity for obvious reasons. The past couple of months is more gold or less gold. I know one of your holdings are gold fields. Just quickly, your views on gold or gold miners at the moment in portfolios. So something you're upweighting, downweighting, and then exposure to PGMs as well.
Yeah, so I'll start on PGMs. PGMs, we have We do have an overweight in PGM, so we do hold some of the PGMs, and they've performed pretty well for us, and we're happy for that. From a gold perspective, we have been neutral. I mean, gold has run, and you know, for the gold outcomes are depending on what the price does. We think that the price probably remains elevated, given some of the geopolitics at play, given some of, you know, what central banks are doing. But our positioning overall, we don't have an outsized position in gold. So, you know, there is some risk management that we do think about there, given how concentrated the index has become to gold. So we don't have an outsized position. We do have some gold fields, and I think we've also got some Anglo gold. So we do have some gold, but as I mentioned, it's not an outsized position at this point. So, you know, we're not sure how much further it runs, but we kind of think it remains elevated.
Just one very last question. I saw also in your asset class ratings, SA property, you neutral, and you also had the comment there, the easy money has been made. How does property find a way into your portfolios? Do you start with a strategic asset allocation and you allocate a percentage and then tactically around that? What is that weight at the moment, and how do you bring it into a multi-asset fund?
Yeah, so property, I think we had about a 2% overweight. And then given the run in property relative to some of the other sectors in SA, so that overweight ran a bit, and then we could, you know, we brought it back a little bit to the extent that we are neutral. But, you know, with property, we look at it like, you know, any other asset classes. We say, what are the expected returns? What do we anticipate over the next 12 months, over the next 3 months? And then we almost do, you know, so we don't have point estimates. We kind of say, on a ranked basis, what do we think will outperform in the next, in those periods? We do take the risk into account. So on a risk-adjusted basis, property has done pretty well. We think most of the return has been captured. There has been a lot of the, if you look at the last 10%, I would say, in terms of the run in property, has been driven by lower bond yields, right? So we think that that's already in the market. Operationally, if you look at the metrics, they are positive. I think a lot of that is already in the price. So yeah, in property, like any other asset class, we look at our expected returns, and then from there we estimate effectively on a ranked basis where we think over those periods where we should be positioned.
And I mean, very prominently, that one slide you showed, it's not about a particular asset class, it's looking at all the asset classes and how they perform collectively, and that's how you bring it together in the portfolios.
Yeah.
Like I mentioned, we're very familiar with your global equity fund. We've seen the skills of Mazi in the past in managing global equity, and you do move when you need to move. It's very exciting to see how that's going to manifest in your multi-asset mandates going forward. And I'm sure that we're going to have a lot more conversations on that as well. Kopano, I'm going to step off from Mazi Asset Management for now. Bruce, I've kept you waiting very patiently, and my apologies for that. If we can look at your fixed income fund just very briefly, and your business, you've got that hedge fund background. You also very prominently said, you know, your portfolio managers are the hedge fund managers as well. And we've heard this a few times from hedge fund managers to say, but you know, you bring hedge fund thinking into a long-only space. But maybe just to define that from your side, I mean, how does that influence your holdings in a fixed income or your core fixed income fund? How does that hedge fund thinking manifest?
So the sector that we're looking at now was the CISA interest-bearing short-term. So, you know, in the CISA, you get money market short-term, variable term, and then you get inflation-linked. You get 4 products in the CISA interest-bearing. So we're allowed to take up to 2 years interest rate risk in short-term. So what that means is the average duration of my interest rate cannot be longer than 2 years. So as I said, most of the mainstream guys, what they do is they buy cash plus 100 basis points, and it resets very quickly. Whereas what you'll find from a hedge fund manager is a hedge fund manager will understand the rules that he's playing in, which is up to 2 years. So we will take our duration. Our duration on our fund at the moment is 1.95 years. So we right up at 2 years. That's our duration, and that's where we will try and add the extra value from understanding the market and understanding the interest rate cycle, rather than just coming in every day and buying a cash plus 100 product.
Well, putting it bluntly, thank you for that. You also mentioned that you've got a flexible property fund, and we've spoken about this before with other managers. Do you think that property should find a way back into clients' portfolios looking to derive income?
Yeah, I do think so. I think we're quite positive on property at the moment. I think South Africa's got a good story at the moment. I think next year when we get our debt ceiling, when they start discussing debt ceilings in South Africa, and this is the very first time in 15 years that our debt to GDP is not going up for the next 3 years. So the budget, actually next year's budget, the debt to GDP is coming down. So for the very, very first time, we're actually starting to get budgets where they're telling you that the debt to GDP into the future is going to be lower, which is very good for the economy ultimately. And so we're very positive on property at the moment. We think that there's a lot of space in the property market, as in the fixed income market, because we think fiscally, South Africa is looking really, really good where we are at the moment. Operation Vuluzela, when you look at what they're doing in Transnet and in Eskom, previously I've always said we do have one issue, and that is the municipalities and the debt collection in the municipalities. But other than that, we think that South Africa is in a really good space. And I mean, we know that, everything's run very hard so far. But I think from a relative perspective, if we're able to get our debt under control, and we are able to bring our, we're having positive primary budgets at the moment, which is really, really good.
Exactly, and more good news out there if you just look for it. Don't read the papers. Just with regards to some very interesting numbers you showed on funds that needs to find their way to SA fixed income, an extremely high demand and low supply. But what is the direct impact on bond yields? Does that mean that bond yields could potentially stay a little bit higher for longer, which is good for fixed income funds?
So I agree. They've obviously run. So when you look at bond yields, they've run from 13% down to 9.5%. If you look at the very back end, that's a big run. And I think a lot of people are struggling to get their heads around the fact that should I be buying a back end bond at 9.5% or a 10-year bond at 8.70 or whatever. If we consider that National Treasury has now adopted the 3% inflation target, which means that going forward, the expenses will be bound by sort of that 3% type of philosophy when it comes to salaries and to expenditure. There's no reason why that primary surplus can't get higher and higher and higher from a South African perspective. And with that in sync, what it just means is that there's just less and less supply from South Africa. And as that supply diminishes, the yields will carry on dropping.
Yeah, what does that mean for clients going forward with regards to reinvestment rate? Is it something we should be worried about? Because I mean, we've been spoiled rotten the past 18 months. How do I position my clients?
Yeah, look, bond funds have done really well. They've done 20% 2 years in a row. So the bond funds have done really, really well off the back of that. My thesis would be that they can still do well again next year. Remember, the point also about these credit ratings, as I mentioned, we're on a positive outlook. So they generally move within 12 to 18 months. So this time next year, we could be at double B plus, which is only one notch away from WIGB. And when you get included back into that WIGB index, the WIGB, actually, I've got it here, it's $33 trillion US. And when we were included in 2012, we were 0.5% of that. 0.5% of that would mean that people have to come and buy 2.9 billion South African bonds. 2.9 trillion South African bonds. That's more, so the foreign ownership in South Africa was up at 40% in 2012. The foreign ownership is now down at 30%. So, if we start getting that positive momentum and we do get back to investment grade, there's a lot of buying that has to take place in South Africa. And remember, these are people that are tracker funds. So they don't necessarily look out for, should I buy it or shouldn't I buy it? They've got to perform to their mandates. And the Wigby's average yield at the moment is 3.2%. So that they can't afford not to have us in at 8.5%. So the argument would be that they have to come and buy us, and we would our foreign holdings would again go from 30% maybe back up to 40-45%.
Very interesting indeed, and the outlook remaining very positive, and I think you illustrated extremely well how your hedge fund thinking plays a big role into, well, it's simple as that. Good performance numbers for clients, and it's on the table. Bruce, thank you so very much for joining us this morning. Kopano, you as well. The clock caught up with us, been very insightful to our audience. You know how it works. All our managers have an open door policy. If you want to know more about Mazi Asset Management or Bruce's business and their funds and their thinking, give us a shout. We'll get you in touch and you can further those conversations. Gentlemen, thank you so much for your time this morning.
Thanks.
Quick reminder to our audience, we moved our hedge fund workshop out to the 27th of November, so that is next week, Thursday. But before that, next week, Wednesday, interesting panel discussion where we continue conversations on SA fixed income with the likes of Methodical, Portfolio Metrics, Granite, Sasfin, and Rudolf Horn from Might and Optimal to moderate the session. It's going to be a panel discussion. It's going to be very insightful indeed. And that will be followed next week, Thursday, by our hedge fund webinar or workshop. Thank you all for joining, your continued support, and looking forward to seeing you again next week, Wednesday. Have a great week further.